Fellow risk takers, this is your worst. Podcast host Andrew Stotz from A Stotz Academy, continuing my discussion with Larry Swedroe, who for 3 decades was the head of research at Buckingham Wealth Partners. You can learn more about his story in episode 645. Larry stands out because he bridges both the academic research world and practical investing. Today, we're diving into a chapter from his recent book, Enrich Your Future, The Keys to Successful Investing. Specifically, we are looking at Chapter 30, the economically irrational investor preference for dividend-paying stocks. Larry, take it away.
Yeah, this is one of my favorite chapters because it deals with, I think, one of the great anomalies, which is that despite an overwhelming body of evidence, a lot of investors have a preference for dividends, even though there's no economic theory to support it, there's no data to support it. And when you show the people the evidence and the data, they have a confirmation bias and ignore anything that you show them that doesn't agree with their preconceived notions. It's simply incredible to me that people can just ignore, all the theory and the evidence because it doesn't happen to agree with their preconceived notions. So it's been long known that for behavioral reasons, people have a preference for dividends, even though it is completely illogical and easy to show. In fact, you're an academic, you teach classes. You know, one of the favorite activities of professors is writing papers that disprove what somebody else had written, right? Okay, so in 1961, Merton Miller and Franco Modigliani wrote a famous paper called Dividend Policy, Growth, and Valuation of Shares, in which they showed empirically that dividend policy should be irrelevant to stock returns. That was now 64 years ago. And not a single paper has been written that shows anything but that. No one has refuted it, and yet we get it. And it's easy to show people, as I describe in the book. Because unless you think a dollar is not worth a dollar, then you have to understand dividends are irrelevant, and it's easy to show. So I give an example. Let's say you have a stock that's worth, it's got $10 book value, okay, and it's trading at at $10. So it's trading at 1 times its book. And you have another company that's exactly the same. Also has a $10 book and trading at 10. Both companies earn $1 a share. Okay. If at the end of the year that one has paid a dividend, what has happened? An investor, say at 100 shares times 10, so at $1,000. Okay. The stock is still trading at 10 because it's trading at 1 time book, and therefore it's still worth 1,000, but they got $100 in cash before taxes. Of course, in the US, many other countries, you have to pay taxes on those dividends. Okay. Now you have another company that earns the same dollar, but it chooses not to pay a dividend. So now it's trading at $11 or 1 time book, and you have the same $1,100 before taxes. But since you didn't receive any dividend, certainly for a taxable investor, you're ahead. And if you don't need the cash to live on, you're clearly better off not doing that. In addition to which, if you don't need the cash, okay, the company now has more capital which it can reinvest and therefore should be able to grow earnings faster than the company that paid the dividend, as long as it earns its, cost of capital. So you're ahead from that perspective. Now, despite that simple logic, that even if you needed the dividend, you could sell $100 worth of the stock, at $11. So you don't even have to sell 10 shares. You sell 9, 0.09 or whatever, and you end up at the same place. But for the taxable investor, okay, you're ahead because you pay a tax only on the portion that's the gain, not the entire amount of the dividend. And so therefore you're ahead that way. And
Yeah.
yet, despite that simple logic and simple math of this example, you have people who think that there companies that pay dividends have like what's called magic pants. You could take the dollar dividend out of one pocket, put it back in another, and think you're worth more. But it can't be. Your company's stock has to be worth less after the dividend is payment, unless you think a dollar isn't worth a dollar. Simple.
So there's a bunch of different angles. I want to tell you a story about a parliamentary debate many years ago in Thailand, and they were grilling the finance minister for not distributing enough of the dividends from the state-owned oil and gas company. And they said that, you're disadvantaging the treasury of the country by not paying out more dividends. Now, where it became very interesting was nobody discussed on the floor of the parliament that the company was making a return on invested capital of 40% with a cost of capital, let's just say 10%.
Right.
So they were creating value of 30%. Now, you could have another argument saying they should lower the prices to the consumers, to the population. But let's just put that argument aside and just say, so here's a situation where if they took the money out, and at the time, deposit rates were about 1%. So they wanted to get the money out of the company and into the deposits, of the finance ministry, and say that that would be better off for the population. What's wrong with that, Larry?
Well, it's pretty simple. If they needed cash flow, which is possible, the government could have sold some of their shares enough to generate whatever dividend they wanted to receive. Investors always have the option of creating a self-dividend if they need it.
So what?
Effectively, this is really important for people to understand. When a company pays a dividend, and people don't think of it this way, but this is exactly what's happening. They're forcing you as an investor, whether you like it or not, to disinvest and sell equity, if you will, in the company. Now, you still have the same number of shares, so people don't think of it that way. But the company is worth less, so you have disinvested from that company when you may not want to do it. Now, you can replicate that or undo it by dividend reinvestment, which a lot of people automatically do. But you still have to pay taxes on the dividend you received, which makes it dumb from that perspective. So companies really have a choice. They could keep the cash and grow it, if their return on capital is higher than the cost of capital, that's the logical thing. They could pay a distribution out if they're unable to earn their return on capital, or if they believe their stock is really undervalued, then they could buy back the shares and in effect pay a dividend that way by driving the price up. And if you need the cash flow, right, then you could sell a few shares, putting you right back where you were. It really makes no economic sense to pay a dividend unless you're not earning your cost of capital.
And it gets really clear when you look at this excessive level of value creation, right? Where we're talking about 40% return on capital versus a 10%, let's say, cost of capital, where from a pure business perspective, you want to have as much money in that company as possible to invest at that 40% rate until it starts to come down. And even if it came down to 30%, you still, even though additional investments have a lower value creation, the value creation is still huge. And so from a company perspective, ultimately they would never want to take any money out of that. You want to keep that compounding and growing. Would I be right in saying that?
Absolutely. In fact, while Microsoft investors have done great since they've started paying dividends, they've been worse off than if the company had used it either to buy back their stock, right, or reinvest it in the company if they didn't have enough good uses, right? So either way, they would have been better off because the company has continued to out earn its cost of capital. Why do you think Warren Buffett has never paid a dividend from Berkshire Hathaway?
Yeah, in
Because
fact,
he
you
has
reference.
felt investors were better off by him keeping it, and he's out earned his cost of capital. Now, there is one thing that we should know, there are 2 points that we should make here. If dividends were an indicator or an explanatory variable of equity returns, then it might make sense to own dividends. However, we have many models that have been developed as we've talked over the time we've been having our discussions. The first model of asset pricing theory was the CAPM, and the single factor was market beta. So that, of course, said dividends don't matter. There's no dividend in the model. The second model was the Farmer-French three-factor model, which was size and book to market. Again, dividends didn't matter. Then we added momentum, and we still don't have dividend. And then we added profitability and cash flow. And there are other factors that people have used, hundreds, and not one of them is dividends. Now, if you look at value, dividends could be used to determine value in the sense that you get a high dividend yielding stock is a value company, and a low dividend yielding stock would be a growth company. You could use that metric. It turns out that there is a slight premium there, but it is by far the worst of all the value metrics you could use. So price to cash flow, price to earnings, price to book value, EBITDA to enterprise value are much better explanatory models.
Mm.
So that should tell you, again, dividends don't matter, all else equal. Now, the last thing I will say is this, that dividends can be used as signals by companies to shareholders. So if companies say, increase their dividend, because we know companies hate to cut dividends because it sends the wrong signal about the future of the company. They're at risk at bankruptcy or whatever. So if they raise the dividend, they have to be highly confident they won't have to cut it in the future. So that could be a positive signal. But it turns out that companies with increasing dividends don't outperform companies with similar metrics of price to cash flow or other metrics that matter. So even there, it may be a signal that it's a relatively safer investment, but that should tell you it's a lower expected returning, not higher expected returning investment.
And I have two last questions. The first one is, imagine, in a case that you are the sole owner of a company. And let's imagine, for the sake of argument, that it's listed in the stock market, which can't really be. But let's just say that there's a market price set every day for your company. And you decide that you want to, let's say, take cash out of the company. You can do a dividend, or you can sell your shares, let's say, and let's say you're
Right.
willing to sell it to somebody and they'll come in as a new shareholder, as an example. But the point is that let's now factor in that let's say you've got a 40% return on invested capital and a cost of capital of 10%. When you take that $1 out of the business, the price of the company is going to fall by $1.
Right.
You're going to receive $1, and let's just say you're going to put it in, 3% bank deposit.
Right.
You yourself individually have just missed a huge opportunity, because that dollar in your account, your bank account, versus that dollar in the company is just two worlds apart.
in
So
terms of expected but not guaranteed returns.
correct. And
And
let's
you haven't even considered tax implications
yeah,
there.
and let's say forget tax for some. I'm simplifying it as for the simple-minded guys like me. And
But
then
we do live in a world where most people pay taxes on dividends, right?
well, let's just say that the tax rate is equal for dividends and capital gains for right now. And
But even if you assume that,
yeah,
so let's say in your example, the person takes $1 million out in dividends. They pay a tax on the $1 million. Now, let's say they take it out by selling shares. Okay. Let's say the shares were trading at $10 a share. When they bought it or made the initial investment, their cost basis was $5 a share. Now, when you take the $1 million out, you're only paying tax on $500,000, which is the gain. So, depending upon their cost basis, you're clearly, you can't be better off with the dividend and you could be much worse off. Imagine an investor, okay, who is sitting with a loss on their stock and says to himself, I don't want to sell my stock, it's at a loss. Okay. But he takes the dividend and now he's paying tax in the US, pay the tax on that dividend. When he could have, in theory, let's say, not taken the dividend, okay, and sold shares, he would get a tax loss, not pay any get tax at all, right? So why would you prefer to own the company that's paying the dividend? There's no logic to it.
yep.
None.
And let me just ask one last question about that, and that is when you take that dollar out, and again, we all know that nothing's guaranteed, but what you can see is that highly profitable companies tend to remain above average from what I've my testing. So let's say that this
For
company's
at least some period of
period of
time.
time.
Because
I,
we talked about this, that companies that grow their earnings abnormally above the average that rate of abnormal growth tends to revert to the mean at 40% per annum. So they tend not to keep going. And the best testament to that are companies like Kodak and Polaroid,
hmm.
digital equipment, and we could go on and on and on. But
So
yes, over the short term, profitability is persistent, but at lower and lower rates.
and we know in a let's say a discounted cash flow type of valuation, the earlier periods have a huge, impact.
Yes.
So let's
Yeah,
just imagine
absolutely.
that, this business can continue on at a very high level of value creation for the next 10 years. And
Yeah,
so let's assume that. Now, when I've taken that dollar out of that business myself, I've missed a huge opportunity for that dollar, right? And so my
absolutely.
question is, did I decrease the value of my business by a dollar, or did I decrease the value of my business by a dollar with the potential? Because when we're valuing it, we are expecting this relatively high level of return. So, am I taking out a dollar, or am I taking out $3
Well,
with
in
that $1?
present value, depending on what you do with it, because you could put the money and buy back the stock, in which case you would be out only the tax differential, and then you could present value that, right?
Mm.
But your answer is if you earn higher returns and put the money in your bank account or spend it, then you've given up way more than the present value of a dollar because your cost of capital is below your return on
So
equity.
let's now go into the open markets. We see companies buying back shares all the time, and people see it as really good news. It's going to reduce the number of shares. You're going to have a slightly higher percentage ownership in the future. But
Right?
if it's a very high returning company, is it really a dollar comes out of that company and the share price falls by a dollar? All they've missed is $1?
Well, you got to remember that depends on what they would have done with the dollar. They have to think the stock is undervalued. Otherwise, they'd be better off keeping the cash and reinvesting it in the business. So they would be management is making a judgment that the stock is undervalued, or we can't use all of our capital and get a 40% return. There are only certain investments. Let's say we've got, $1 trillion in cash, like Apple might have or something,
But in
right?
this case,
Maybe they can only put 500 billion to work, and the rest investments would get a lower return than the cost of capital. Then they would be better off buying their stock back.
and again, going back to this somewhat persistence of a value, making additional value in the company. And now let's now look at another company that's earning for the next 10 years the cost of capital. That's fine. It's not bad because you've cost of capital has the risk factored into it. But one's got the cost of capital. I can see if you're earning the cost of capital that you take $1 out, it's worth $1.
That's
But
right.
it's harder for me to see that $1 coming out of a highly profitable company is $1.
No, it's not. In present value, it's in terms of expectations, it's worth more. So it would not make sense. That is why Nvidia and Apple and Microsoft either pay no or very low dividends,
So there's a
because they
trade-off.
know they're increasing shareholder value by retaining that capital.
So there's a trade-off between the fraction that you own in the company rising because of the number of shares falling and the value creation that the company's missing by that money not being
Well,
in the company.
it depends again, because let's say you're only able in that example, let's say you're Apple and you got 1 trillion of excess cash. You may not be able to invest 1 trillion at above your
Right.
cost of capital.
Which we
They only there's only a certain amount of investments
understand that.
will meet that criteria. The companies always face that decision, right? What's my cost of capital, and does that investment exceed that cost of capital? If it doesn't, then I should probably not make it.
So does this imply that when highly profitable companies do share buybacks, their share prices should go down?
No, again, you have to ask it's the question. Management hopefully is looked at the analysis and said we're better off buying the shares than to keep that extra cash,
Right.
because we have put our cash available in all the investments that we think on a risk-adjusted basis exceed our cost of capital. This other cash, we're better off. We think our stock is undervalued, and we'll buy that stock back.
Yeah, and this chapter is not really about buybacks, but as you say, there's another factor, and that's what's the share price. If the share price is super low and the returns are super high, yes, makes sense. One last thing on this topic. That's my last question, I promise. And then you'll get on with the rest of your evening. If the market, if investors are truly irrational in their preference for dividend, how can we, as rational investors, capitalize on that or take advantage of that
Interesting.
irrational?
There's a paper. I think it's a brand new one. I just read it. Might have been somebody sent it to me, whatever. But showing that at least before costs, uh, let's take the high frequency traders can clearly exploit it.
Mm.
And because they show that stock prices tend to rise in the month before they pay the dividend, because dumb retail investors overvalue dividends, and then they tend to revert back after the dividend gets paid. So if your costs are very small and trading, and you can front run the dumb retail money, you might be able to do that. I don't know if it
You
holds
mean
up.
before they're buying it before the dividends announced?
Yeah, no, they know it's coming,
Yeah.
but let's say it's expected, but let's say the dividend is paid on March 30th. That and they know from history, I'm just now making this up
Yeah.
because I didn't read the whole paper in detail. I just read the summary of it, the abstract and the summary. Let's say the dividend retail investors start buying 2 weeks before. A lot of stockbrokers tell people what a great strategy. We're going to capture 5 dividends in just a little over a year. So we'll buy the stock. So the high frequency traders come in say, on March 13th, buying knowing dumb retail money comes in on March 15th. They push the stock up, and then on March 29th or 30th, they sell and push the stock right back down to where it was before. Now, again, I don't know if it holds up after,
Hmm.
but it certainly tells you shouldn't buy a dividend paying stock in the month it's about to pay a dividend. You'd be better off owning the market for that 30-day period.
Well, I want to thank you, Larry, for this discussion. And we went into a lot of interesting stuff. I know it's valuable, and I'm looking forward to the next chapter. And the next chapter is chapter 31, The Uncertainty of Investing, where you talk about risk and the difference between risk and uncertainty. For listeners out there who want to keep up with all Larry's doing, follow him on X, Twitter at Larry Swedroe, and you can also find him on LinkedIn. This is your worst podcast host, Andrew Stotz, saying, I'll see you on the upside.